Welcome to the ProTicker Deep Dive. We are jumping straight in today. You sent us a mountain of sources, a really detailed analysis of consumer credit stress, pulling from bank data, Fed reports, and some pretty sharp analyst insights covering both the U.S. and the global picture.
It's a lot to get through.
It is. So our mission is crucial, and it's simple. We need to filter through all the noise, all the scary headlines, and figure out what the rapid rise in consumer debt defaults actually means.
Right. Is this a full-blown crisis coming our way?
Exactly.
Right.
Or are we just, normalizing after a couple of very, very strange years where stimulus money sort of wiped the slate clean for a little while?
And the answer, really, it lies in the nuance. The core finding you pulled out is spot on. Consumer credit quality has deteriorated sharply. We're way off those pristine levels of 2021.
Some parts are hitting decade-plus highs in terms of stress.
They are. But here's the critical distinction, the thing we have to keep in mind. While the stress is severe, the data suggests the overall systemic risk is, for now, manageable.
Manageable because the pain is so concentrated?
Precisely. It's not spread evenly. And that concentration is the real hook, isn't it? It's the core of what we're looking at today.
It is. It's why every analyst is calling this a K-shaped consumer credit cycle. It's just the perfect metaphor for what's happening.
It really is, because you can instantly picture that divergence in financial health. You think of the letter K, that
Right.
upward sloping arm, that's your high income, your prime borrowers.
The ones who did well with asset prices still have cash buffers.
Exactly. They're doing fine. They're servicing their debt. They are, for the most part, healthy.
And then there's the other arm of the K, the one sloping down.
And that's where all the stress is. Lower income, subprime segments, they got hit hardest by inflation. They burned through their savings. And, now they're the ones using high-interest credit just to cover the basics.
So we're really tracking two completely different economies happening at the same time, all under one big headline.
That's the story.
Okay, let's unpack that. Let's start with the U.S. picture. If you zoom all the way out, the big aggregate view, total household debt delinquency is kind of plateauing.
Yeah.
It's around 4.5% as of Q3 2025.
Right, which is definitely higher than the pandemic lows, but it isn't spiking uncontrollably. The fact that it's leveling off, that provides some comfort.
And there's another data point that backs that up, right? The debt service payments versus income.
Yes, exactly. That ratio has steadied out around 11%. And what's interesting is that's actually lower than pre-COVID levels. So for the average American household, debt is still, in aggregate, affordable enough to avoid some kind of massive systemic event.
So the macro picture is holding together.
It is. That's the resilience that's preventing a crisis.
But we know the devil is in the details, and that's where the K-shape really, really shows itself.
Yeah.
So where does that big, stable picture start to break down?
You have to look at specific products, and the main pressure point is credit cards.
Always the first place people turn.
It is. It's where you go when your income just doesn't cover expenses. And we saw delinquencies and charge-offs just surge past pre-pandemic levels in 2024. The net charge-off rate, so that's debt banks just write off as lost.
Uncollectible.
Right. It peaked near 4.6% in the third quarter of 2024.
The 4.6% charge-off rate. That's a complete reversal of that pandemic-era health.
Yeah.
How fast did that happen?
Incredibly fast. And it was fueled by two things, really. High inflation eating away at paychecks and just soaring average credit card APRs. We're talking 21, even 22%.
Wow.
I mean, you combine bigger balances with record high interest rates, and you've basically created a debt trap. It's almost impossible to escape if you carry that balance month to month.
But here's where it gets interesting based on the sources. You mentioned stabilization. Did that surge just keep going up and up?
No, and this is the key nuance for the outlook. It looks like it peaked. It's starting to ease. By Q3 of 2025, those quarterly charge-offs had eased a bit, down to around 4.1%, and delinquencies dipped.
And the K-shape.
This is the ultimate validation. Virtually all of this stress is in the subprime cardholder segment, prime users. Their delinquency rates have barely budged since 2022. They're paying off their balances. They're not feeling those 22% APRs.
Okay, if credit cards show a divergence, then auto loans must be the most extreme example of the K-shape. The split here is just stark.
It's incredible. Prime auto loan performance is strong, very strong. 60-plus day delinquency is holding at, 0.37%? Super low.
But the other side of that K.
The subprime side is, and I don't think this is an exaggeration, it's catastrophic. In October 2025, the share of subprime auto borrowers who were at least 60 days late, it hit an all-time record high. 6.65%.
Wait, say that again. An all-time record.
It's an all-time record. It's higher than the absolute worst peaks we saw during the Great Recession in 2008 and 2009. We have never seen this level of failure in the subprime auto market.
And that's happening with unemployment around 4%. That's a truly alarming signal of stress. Why auto loans specifically? What's so unique there?
It's a perfect storm. You have stubbornly high car prices from all the supply chain mess, combined with high interest rates on the loans themselves. The result is just massive monthly payments.
Payments that were only sustainable if you had a savings cushion.
And that cushion is gone. So for every 100 subprime auto loans out there, nearly 7 are in serious trouble.
We're already seeing the fallout for the lenders, too. The sources mentioned PrimaLend and Tricolor, two subprime financiers.
Filed for bankruptcy in late 2025. Yes, that's the real-world consequence of that 6.65% number. It shows this isn't just some slight dip. For that specific segment, it is a full-blown crisis.
Right. Okay, so to provide some balance, there are less stressed areas, mortgages, for instance. How are they holding up?
Mortgages are still the bright spot. Serious delinquencies, so 90-plus days past due, are near record lows, still around 1.3%.
And that's because of high home equity and better underwriting since '08.
Exactly. The post-2008 rules are working as intended. Mortgage debt is stable.
Okay, what about student loans? The payment pause ending was a huge shock for millions of households.
It was, and we saw an expected spike, but it wasn't a crisis point in itself. Delinquencies for 90-plus days jumped to about 10.2% after payments restarted. But, and this is crucial, that just brought the numbers back to where they were before the pandemic.
So the real impact was more indirect.
I think so, yes.
Yeah.
It wasn't a direct default wave. It was more that it just sucked disposable income out of millions of budgets, which then put more pressure on those high APR credit cards and auto loans. It's a contributor to the pressure, not the main driver of default.
Let's shift gears then. Let's talk about a structural change that's making all of this worse. Buy now, pay later. BNPL. This is not some niche product anymore.
Not at all. We're talking 91.5 million users in the U.S. alone by 2025. It's massive.
And the really fascinating thing, the real single of stress, is how people are using it now.
Mhm.
It's fundamentally different.
Absolutely. It started as a way to finance, a new phone or a designer jacket, discretionary stuff. But
Right.
now it has bled into necessities.
Give us the numbers on that. They were shocking.
They are. A full 25% of U.S. users finance groceries with BNPL by 2025. That's up from just 14% the year before. And maybe even more telling, a third of users said they see it as a bridge to their next paycheck.
So it's not a convenience anymore. It's a lifeline.
It's financing milk and eggs. I mean, if that's not the clearest red flag that the consumer cushion is gone for that bottom part of the K, I don't know what is.
And the performance data for BNPL itself, it just sets off alarm bells.
Oh, immediately. The sheer number of late payments is a huge concern. About 4 in 10 users, so 42%, said they had at least one late payment in the past year.
And compare that to a prime credit card where delinquency is, what, 2 or 3%?
It's a different world, and it confirms what we already suspected. BNPL users tend to have lower credit scores and more debt elsewhere.
And they're stacking these loans. The CFPB found over 60% of them have multiple BNPL loans going at the same time.
Which brings us to the core structural risk of this whole thing: phantom debt.
Flying blind. That's what the Capital One co-founder called it.
It's the perfect term. Because this BNPL debt is often invisible to the traditional credit bureaus, a person can rack up multiple loans from different companies in a single week. The auto lender, the mortgage bank, they have no idea about the consumer's true debt load until it's far too late.
So the system itself was actually making the K-shaped problem worse.
Precisely. It was a loophole. But thankfully, the regulators are starting to catch up.
Right. The CFPB rule from May 2024. Why is classifying BNPL as a credit card provider under Regulation Z such a big deal?
It brings accountability. It's not just red tape. It forces them to offer some basic consumer protections that were missing before, like clear disclosures and standardized dispute resolution rights. But most importantly, it pushes them to integrate their data into the main credit reporting systems.
Which would finally get rid of that invisible debt problem.
That's the goal.
Okay, we focused a lot on the U.S. consumer. Is this K-shape an American thing, or are we seeing it everywhere?
It is definitely a global pattern. But what's encouraging is that internationally, stabilization seems to be happening a little bit ahead of the U.S.
Oh, that's interesting.
Yeah, most major economies, Europe, the UK, Brazil, New Zealand, they saw that same spike in stress in 2023, but things started to plateau earlier, by late 2024 or early 2025.
And what's the reason for that?
It often lined up with central banks pausing their rate hikes, or in some cases even reversing them. The ECB, for instance, cut rates just a little in December 2024. And that tiny bit of relief can make a real difference for people with variable rate debt.
Can you give a few examples of that global stability?
Sure. In the UK, mortgage delinquencies leveled off despite the high rates. Brazil, which has notoriously high consumer debt, actually saw its personal loan delinquency rates start to reverse in 2024. And in Canada, credit card delinquencies were back to pre-pandemic levels by late 2024.
So stability seems to be the trend. Any outliers we should be watching?
A couple. Ecuador is one. Personal loan delinquencies are still rising there because of local economic issues. And India, which is seeing just explosive credit growth, rapid growth is always something you have to monitor, just to make sure risk management can keep up.
Let's bring it back to the outlook then. If stabilization is the theme, what are the big macro levers that will decide whether that stressed arm of the K can finally start to recover?
The biggest bright spot, the major tailwind, is the expectation of falling interest rates in 2025 and 2026.
That's the cavalry coming over the hill.
It really is. Lower rates will immediately cut the cost of carrying debt on credit cards and HELOCs. And it could revive refinancing, letting people consolidate high-interest debt into something more manageable. It's a huge potential positive.
Okay, so that's the tailwind. The primary threat has to be the job market.
Without a doubt, a strong labor market has been the only thing preventing this K-shaped stress from becoming a full-blown crisis. But we noted U.S. unemployment has ticked up to about 4.0%. Historically low, yes, but any acceleration in job losses from here.
And defaults will spike across the board.
Right. And that spike would be more severe now.
Because the savings cushion is gone.
Exactly. For the bottom half of households, there is no buffer left. A job loss today translates into a default much, much faster than it would have 3 years ago.
So what does all this mean for our listeners, for businesses trying to navigate this? What's the takeaway for retail or for lending strategy?
For retailers, you have to realize you're in two separate markets. Luxury is fine. The top of the K is spending. But discretionary sectors that cater to the middle and lower end are slowing way down. And for essentials retailers, tracking the rise of BNPL for groceries is a critical warning sign of maximum consumer strain.
E-commerce must be feeling that BNPL pinch too.
They are. They rely on it to drive sales, but they're facing higher fees from the BNPL platforms and, higher return risks if people buy things on installment plans they just can't afford.
And what about the traditional banks? They seem to have seen this coming.
They did. They're well capitalized, and they tightened up their underwriting standards way back in 2023 and 2024. They're also offsetting their losses with record high interest income from those same high APRs. But the key trend now is how they're fighting back against BNPL.
By copying it.
Essentially, yes. We saw credit card installment plan usage grow 46% in 2025. They're bringing the BNPL model back into their own safer, regulated ecosystem where they actually know the customer's full credit picture. It's a much safer way to do it.
Right. It avoids the whole phantom debt problem.
Exactly.
Yeah.
So to just recap the core message from all these sources, this is a manageable normalization. It's not a systemic crisis that's going to take down the whole financial system, but it is deeply painful, and it's very targeted at that bottom 40% of consumers. The good news is that lenders and regulators, they saw this cycle coming and are already putting structural responses in place.
And my final thought for you builds on that. The long-term outlook seems to be this blending of traditional credit with these alternative models. The biggest challenge, really, is going to be eliminating that invisible debt issue by getting all that BNPL data into the system. If we can do that, risk management could actually get better over the next 5 years, because lenders will finally have a complete picture of who they're lending to.
A clearer view for sure.
But I do have a lingering question. Despite the stabilization, despite all the smart moves by lenders, when you have so many people using BNPL for groceries, for necessities, you have to ask, how much of that spending is truly sustainable? And what happens when the job market wobbles even a little bit for people who are depending on multiple overlapping short-term loans just to get by? That's the real fragility hiding inside that K. See you all in the next Pro Ticker Deep Dive.